Good morning, everyone. It's Ben Buckner and Dan Bosse with Ag Resource Company in Chicago. We are back to run down everything that's happened in the last week and what's in front of us, we think. And I think something that we wanted to communicate, and we've done this in the newsletter, is markets are a little chaotic now. And I think we've got to separate fundamental risks over the next 6 months and also geopolitical risks over the next several months. Those are very different. So that's why I think the markets, it's really complex, especially. It's been very fluid. And on any given day, it's hard to separate those. And those look very different, I think, too, when we think about weather patterns globally, which look pretty good against biofuel policy in the U.S. And still, of course, does China come back to the U.S. soybean market for old crop supplies, given the Supreme Court has ruled Trump's previous IEEPA tariffs unlawful. So there's a lot going on in the markets. I do think that our kind of North Star is still going to be weather patterns, fundamental supply and demand. I think you've got to change balance sheets to really change price direction, but there will be nuance to the markets. Then I'll pass it to you and let you break down what you were seeing this morning and this week.
Yeah, Ben, I actually believe the geopolitical front will be calming down. I only say that because our president lost his big hammer. That hammer was IEEPA. The president could threaten anyone, anytime, anywhere with tariffs of size and substance. And so with IEEPA gone, he's now left with investigations or a much smaller hammer in terms of maybe Section 201 or 301 or 211 or 338 or some of these other tariff sections that are out there. But they all require investigation, or some of them require investigation, and they're much smaller in amplitude. So, the president does not have the immediacy to come at China, come at countries and threaten things. I think if he was looking at taking over Greenland today, the discussion would be far different. Now that IEEPA tariffs are in the rearview mirror. So that IEEPA is going to be very important. And I think geopolitically, it's going to be calming of the markets. And I think we're going to see that as some of the trade tariff dust settles as we look at the coming weeks and months. Here today, of course, the big discussion topic is China's back from holiday. Will they or will they not start to tender for U.S. soybeans? So we'll be watching this carefully at Ag Resource over the next couple of days. Xi and Trump, of course, are shown here in the picture in their last visit back in October. We have another visit planned for early April. We'll see how this all goes. But with IEEPA tariffs gone, I believe the Chinese negotiating position is much stronger. And I only say that because now without that hammer, someone's going to have to write down these trade agreements. They're going to have to be codified. They're going to have to be negotiated. This takes a lot more time. And so when you don't have a hammer to throw over someone's head, it does take more, of course, legitimacy in terms of getting a trade deal. Saying that, I do believe it will be an extended period of time that the U.S. and China will be in some kind of trade dance. I don't think it'll be as immediate as we saw in October, or maybe with rare earth minerals going back to last May or July. We'll see how this all plays out. But with the soybean market back at its old highs, it's dialing in a very strong portion of that 8 million metric tons. Will China buy it or not? If China doesn't show up by the end of the week or early next week, I think the market's going to set back just because of likely it'll wait till after the negotiations in April and really see where we're at. So that would be somewhat disappointing in terms of what we expect. At the same time, Brazil is rapidly starting to increase its exports. Prices do matter. In the case of Brazil being $1.10 to $1.20 under for much of the last couple of weeks, it is showing that they are accelerating in their soybean sales commitments. Now, these are export commitments down at Brazil. You can see they're at record large rate. They are really accelerating. Brazil is doing what it has to do to get rid of this monster crop, which we at Ag Resource think is over 182 million metric tons. On the other side of this, however, is U.S. I'm sorry. Let me just talk a minute about ship lineup here. The U.S. ship lineup that we follow every week at Ag Resource. This, of course, through Friday. You can see here that the U.S. ship lineup is now over 260 vessels waiting, 15.4 million metric tons. This is following the 2022 lineup fairly closely. But again, I think we'll exceed it based on the size of the crop in Brazil. So very strong export lineup. This showing that, the United States is now seasonally on the backside of the shipping pace. This chart aptly shows that the same time frame, February 19th or 20th. Notice that U.S. Vessels waiting to load soybeans are now in seasonal decline. And we would expect this to continue as we head into the end of the crop year. So as the Brazilians ramp up sales and exports of beans, we're on the other side of that. And again, if China does not take its 8 million metric tons of U.S. soybeans, Ag Resource needs to start looking at dropping its export estimate again on soybeans. I believe we're in the early stages of that, but we'd like to get through this week and early next week to make that determination. As you think about the other supportive factors for the soybean market, and yes, we have that April meeting in China, but we also have this RVO announcement. I'm told this morning the documentation hasn't made it to the White House yet from the EPA. That is expected any day now, but the soy oil market has run up trying to anticipate when an RVO decision will be announced. Now, the market's optimistic on RVO. They're looking at this and saying, President Trump, if he can't get it going on trade, he's going to have to do it domestically. And so he may do something important with RVO. Maybe 5.2 to 5.6 billion gallons of RINs would be the equivalent of where we're thinking. But on the other side of that, we do believe that a whole RIN will go to foreign feedstocks. We also are unknown in terms of what will happen on the SRE reallocation. Our mindset will be there will be a compromise. So it will not be one way for the U.S. farmer. There will also be something in here, of course, for the refiner and the blender, which accordingly is looking. But in saying that, the soybean oil rally has taken the crush margin back to $2 a bushel here in the United States. Very fancy, very strong. You can see historically, we're getting back near some highs. We would imagine that Latin America, Brazil, and Argentina are also ramping up their crush rates very quickly here on profitability. And so the world will see a fairly sizable amount of soy products going forward. Argentina this morning has soy oil offered 10 cents underneath the U.S. Futures market and underneath the Gulf for, of course, the April-May timeframe. So the U.S. has no chance of getting any soybean oil demand abroad. And in soy meal prices, they're also in decline, which will cap our rallies. And it tells me that something over $2 a bushel on crush is probably likely to be unlikely or sustainable. And we'll see how that all works out. Lastly, talking about the U.S. weather, the wheat market has had a short covering rally here because of going into the March delivery period, but also squaring positions ahead of a new growing season. Uncertain what the Northern Hemisphere growing season will prevail. But as we look at the chart to your left, that is the blocking pattern that we have today. That is what we see right now. As you look at the pattern on the right, that is what is expected in about 12 days. So the jet stream sinks southward, plains moisture chances improve, the Gulf opens up, and we see a much more favorable weather pattern as we look towards the end of February and the first part of March. Here's a forecast as we look at the 14-day rainfall projection from the EU weather model on left, and then, of course, broad temperatures on right here. So as you look at it, we are becoming more confident that the plains is moving towards a more active weather pattern that will produce needed moisture ahead of the onset of the growing season when the wheat crop exits dormancy and really starts to put on some vegetative growth. All of this would be good, Ben, in terms of where we're going and where we think the markets are headed. But in a broad sense, I'm still of this mindset, as you say, that the fundamentals are bearish. We have oversupply, that we need to reward rallies. And in terms of wheat, we really need a global supply problem or a Northern Hemisphere supply problem if we want to sustain values from where they are today.
Yeah, I think that's all correct. And we've been making a lot of moves in the market the last week or so. And again, $1 gets you in. We're probably going to be making some more moves, extending hedges, managing risk, et cetera. And so I think, thinking about supplies, and even though the wheat market's been one of the star performers, but if you look at a monthly Chicago wheat chart, it's really done very little like it has the last 2 years. And looking at monthly charts of everything, I think makes good sense, kind of passing the risk on rallies to someone else. Weather looks pretty good. We've seen immediate improvement in Argentine crop health following rainfall there. The Brazilian soybean harvest is occurring pretty rapidly, and I think accelerates in the next couple of weeks. And then the sort of shift to wetter weather in the U.S., even Illinois, Indiana, if it were to get, those states were to get 2 or 3 inches of rain, extreme drought is there presently. So that gets eased. And then, of course, Texas, Oklahoma, always welcomed. And probably, or maybe something like El Nino this summer, which on balance does give us mild temperatures in the central U.S. and inadequate rainfall. So we're kind of looking to us that next supply dislocation, which we can't just identify yet. So kind of status quo from us. Lots going on though. Again, dollar gets in. Stay up to date on all the news, price recommendations, risk management, and we will leave it there. Talk to you next time.